Welcome to ADF Property, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
G'day everyone, it's Liam Garman here, editor of Real Estate at Momentum Media, with my co-host Kane Dury, the team behind the Defence Property Podcast. Kane, mate, you guys had a cyclone.
Yeah, almost.
An almost cyclone.
Yeah. Depending on where you live, I guess it was fairly minimal impact in the, compared to what it could have been.
You're on the GC. What did you see on the GC?
Well, we didn't lose power where we are, and we lost internet for about half a day. So it was a pretty intense half a day at home with the kids.
Oh, no. Yeah.
Other than that, it wasn't too bad. We got away unscathed.
Yeah, mate, I've got TPG. I think my internet's out like 3 days a week anyway, so I wouldn't have even noticed it.
There's still a few people that haven't got power back on yet.
Yeah.
Kids are still off school today.
See,
so my wife's at home with the kids.
So why are they off school today? It's kind of over, isn't it?
Yeah, I don't know. It kind of feels like a miniature COVID again, to be honest.
Oh, 100%. I've got opinions, so I've got to hold myself back. Well, one opinion, Kane, I will share. I don't know, you and I were talking about this just before we hit go as we were recording, but I haven't worked out what an ex-tropical cyclone is. Like, how can it's sunny now, it's ex-rain, it's ex-clouds, it's an ex-cyclone, so it's what, a storm? Like, it was just, anyway, people losing their minds.
Yeah. I can't answer that one either.
I've been putting words into your mouth. Look, we've got a sexy podcast lined up today. Kane, buy, hold, or sell. What are you thinking about? What's your logic behind a buy, hold, sell podcast?
Yeah, so we're sort of looking at probably the top 13 capitals or regions or local government areas for barracks by personnel headcount. So obviously Townsville is going to be right up there with almost, I think, around 5,000 people. If we combined the three locations in Canberra will be number 2. And then, top 13 by headcount, with each region getting a rating of, is it a buy area that we're happy to go buy in? Is it a hold that maybe the buying opportunity is closed or closing, and we're just going to hold it? Or is it potentially a sell that we're, for market reasons, market heat, or maybe, it could be yield where it just doesn't make sense. Maybe it's an accidental investment or property that we've purchased there, and, we've got this property with a fair bit of capital tied up, but the yield's not strong enough to justify keeping it. We might give it a sell rating then, so we can redeploy that capital into better buy markets. Now,
I was looking through some of the data you've already sent. Now, we're going to be going through these one by one, but I've looked through some of the data you've already sent through, and there's a massive discrepancy between some of these locations. Some of the yields are in the low 2%, some of them ranging to the mid 4s. So depending on where your posting order is, and I know one of your goals is to be producing this inner report ahead of posting orders, where you'll be going through the analytics, the data of each of the locations, just so people can have a bit more insight into the area they're moving into, and whether perhaps what is their owner-occupier at the moment, whether to keep it, whether to sell it, have a little bit of idea as to whether they should be moving their money. So would you be expecting to publish this report June, July?
Yeah, we're generally posting orders. People will start having career conversations, April, May, June sort of time frame. And then posting orders are released July, August, September, depending on, multiple factors. So I think around that mid-year is going to be a very helpful time to release such a report where the excitement levels are higher. I'm getting posted to Townsville, or I'm getting posted away from Townsville, depending on where you sit and how long you've been there or been away from there. So if we make it a bit of an annual report, at least it helps with, because there's a few layers of complexity here. Our grants, like, do we use Hep C if we have a house in location A and we're going to location B? Do we want to maintain being an own occupier? Or are we considering that rent vesting strategy we spoke about a few months back, where we're on dough house in our own home in area A, we're going to B, so we're then going to try and target some rent assistance and then continue going down that rent investing path, building our portfolio. So by having a buy, hold, sell report on each major region, or 13 of, it's going to help us sort of navigate some of that, knowing our own personal situation. Then the layer on top is the market we're leaving and the market we're going to, and just sort of tying it all together.
So just to provide some colour to the numbers as well, a lot of our listeners might be quite new to property, or they might have their owner-occupier. They might be trying to work out how to actually get DOHAS and the sequence, because I know in previous podcasts, and for anyone who is on rental assistance or DOHAS, go listen to some of our previous podcasts, because we unpack quite in depth the sequence in which you can do this and how to buy, when to do this, when to do that, if you're posted away, how to juggle that. To add a little bit of colour to the data, now this is not financial advice, but
Never is.
Or never is. But what you might consider, Kane, is that say you have an owner-occupier, you're moving to a new town, your owner-occupier now becomes an investment property. Perhaps what you might consider is that if you're in that really low yield bracket, that 2% bracket, that maybe your money could be doing better work for you elsewhere. And especially if you're not living there anymore, you might consider moving your money to a more high yield area.
Correct. And we may say, well, we're getting DOHAS on it because it's so low yield, it might not be worth it. So we may consider that becomes a sell. We've still got our DOHAS entitlement. We're still banking credits and we can use it in the future. But it just comes back to that overall plan, I guess, that if the yield's not there, it probably does make sense to hold it and carry it. So, yeah, we might consider selling that and redeploying the capital elsewhere and, depending, go rent-vest in our new locality. And
make your money work for you a bit more. Now, let's start us off. So we've got 13 locations. Number one, and this is the 3 defence areas located in Canberra. Kane, take us away. What are we seeing in Canberra?
Yes, Canberra's got a yield of 4.03%, so it's not terrible in the scheme of things. Houses are median. This is 2, 3, 4, all betters, 851K with a weekly rent of 660. Our 10, 5 and 1 year growth, right? So we've got 73% average over 10 years, but 34% over 5 years. And over the last 1 year, we were negative 6%.
It's gone down 6%.
Yeah, so you can sort of see that over 10 years it's really hit the long-term average. Because the last 1 year was negative 6, we would sort of expect that I had a bit of a steep climb, and it's the last couple has done like very little and pulled back slightly. But interesting, supply metrics, so stock on market's 0.17, so quite low. And this is over the last 4 years, a mild decline. Our inventory is 0.57, so inventory is expressed as how many months does the current demand levels take to absorb all the supply on market. And then our building approval ratio is at 0.7, which is, again, a downtrend over the last 4 or 5 years. Our days on market is 37, but it's actually in an uptrend. And our vacancy rate is 2.2, which is also trending higher. So there's very low levels of demand there, because we can see that days on market is 37. We like to see that lower, but it's also trending higher, and the vacancies are higher as well. So all up, Canberra has been given a hold that is potentially coming into a period of growth, but it might be a year or two away.
Yeah. So what would we potentially expect, given that the demand, the days on market is going up.
That's
so
right.
A house is sitting there for longer before someone buys it.
Yeah.
The vacancy rate for rents
is
going up.
Yeah.
That 2.2 figure, how does that compare to other areas in Australia?
So at the moment, vacancies are quite low across the country, but 2% is a benchmark for what's considered low. So, and the years following COVID, where everywhere was well below 1%. So 2 in the last 5 years may be deemed high, but if we look at long-term averages, 2% is still a very healthy market, or lower. So the fact that we're at 2.2, it's trending higher. Days on market is trending higher. it's just a hole. We're not going to go diving into Canberra, but it could have some growth in it. And if yield was much lower, like in the low threes or something, we may consider just selling, but because it's a fairly 4%, that's sort of as low as we want to sort of tolerate, I guess.
No, that makes perfect sense. Now we're going to be moving up north, up to Townsville. Kane, what are we seeing in? This is just North Queensland.
North Queensland,
FNQ,
the heart of the army or the heart of the defence. Laverack Barracks, 3 brigades. We've got high confidence data in Townsville. The yield is at 4.1, but interestingly, a few years ago that was closer or over 5%. Because we have seen quite high growth in Townsville over the last couple of years. Median price 617,000 and a weekly rent of 487. So our 10-year, 5-year, and 1-year growth has been 80% over 10 years. So averaging over 10 years at 8% per year. But 5 years it's done 94.
Wow.
So that tells us all of that 80, has come in the last 5 years, and it's actually come out of a trough.
Yep.
And in the last 1 year, 31%. So Townsville is a very hot market.
So take us through this. Before, we would then assume, given that the 5-year growth was higher than the 10-year growth, that in the years preceding that kind of 10-year to 5-year, that would actually might have gone backwards a little bit.
That's right, yeah.
Why is that?
Just because Townsville had a very long period of no growth and even decline. So following sort of 2002, 3, 4 through to 2007, it had huge growth, and then 2008 through to 2019, 20, there was flat, nothing, and even slight decline. So the last 5 years has been quite high, and obviously the last 1 year at 31. And so to go into the supply, Townsville is currently sitting at 0.23%, which is very healthy and trending lower. So there's less and less stock coming on market.
Which is what you want.
Perfect.
That's what you want.
Inventory at 0.66, so 0.6 of a month. Anything under 3 is fairly healthy there. Building approval ratio is at 0.64% and trending lower. Demand is at 37 for the whole region, but that's also trending lower. And vacancies at 2.2%, with a sort of a flat trend there for the last couple of years.
And that is likewise hold, or
so we're going to say it's coming to the end of a buy period.
Yes,
so we're transitioning into a hold period. There's nothing wrong with buying there at the moment. So depending on where you are in your posting cycle and stuff, you may still consider buying there. But then we'll go into a hold period for Townsville.
Well, especially you still have those positive green shoots, those positive indications that are coming through. So that 37 days on market, unlike Canberra, where they're 37 days on the market, it looks like it's getting longer. Townsville's 37 days on the market, but it looks like it's getting shorter.
And we can also add that we're looking at LGAs here. So we can cherry pick our suburbs within each of these regions that we're talking about. So that's key. So there's many areas, and I know vacancies well below 1% in Townsville. There's many areas with days on market sitting under 15 days. So this is high level LGA.
On and off, they're being sold super quick.
So we're always going to cherry pick our suburbs within our regions.
And what would those areas be closer to the barracks, presumably, or?
Well, Townsville everywhere is close to the barracks. I always say there's nothing's really further than 10-minute drive in Townsville. But that's after you've lived in Sydney or the Gold Coast where traffic is horrendous. But we're just going to cherry pick our suburbs for lifestyle and or for database on investing.
You wouldn't be able to swim in the beach up there, would you?
No, they've got stinger nets. So they come down, I think, 3 months of the year when the temperature's too cool for the stingers. But then you got to worry about the crocs and stuff anyway.
I was gonna say, okay. That's nicely done. Now we're going over to Western Australia with Rockingham.
HMAS Sterling. So Rockingham as a region, its yield sitting at 3.17. And again, that's because it's had very high growth over the last few years. Median price is $900K. However, the rent is only $549 per week. 10-year growth has been 76, so 7.6, so slightly higher than our long-term average. However, the 5 year's been 103.
Mate, if you could go back in time.
Oh, I know. And if you're some of our clients, we were buying there a few years ago, and they've ridden that wave up. And then the last 1 year is 20%. So, last 5 years, it's averaged 20% per year.
Yeah.
Stock market's quite lower, 0.34. However, it's trending, it's flat, so it's not trending any lower.
Can you define the stock on market aspect and why it's so important with this data, with these analytics that people consider it?
Yeah, so percentage of homes on the market at any point in time in that suburb. So it's essentially the overall supply. So the lower the better, because the lower number of supply, the less choice there is.
If you saw, like, it makes a lot of sense. It'd almost be if you went back to 2008, it's kind of global financial crisis. You hear all the problems with property, and then if you saw like 5%, well, that's 1 out of every 20 homes up for sale.
That's
That's
right.
not what you want.
Yeah.
Because supply demand, there's more supply, so your cost that you would get for that house would likely decrease.
That's right. And the buyers in a high supply market are spoiled for choice, whereas in a low supply market, buyers are competing for stock.
Yeah, and you've got the inventory figure there as well.
So inventory is how many months it takes the current demand level. If we were to say as of today, no new stock can go on the market, no new listings. Out of the properties that are on the market in that suburb, how long, expressed in months, does it take for the demand levels to absorb all that supply that's on the market?
Gotcha.
You know, and there'll be nothing left to. So in this instance for Rockingham, it's 0.92, so still less than 1 month, and everything in Rockingham is sold and gone if there were no new listings.
And these are the stats that you want to see. The
Yes.
lower the better.
Yeah. And then our building approval ratio is a percentage of new building approvals coming. So that's our new supply or additional supply to the suburb, where stock on market and inventory are existing supply. And 2.74% and trending higher. So there's lots of new supply coming into the Rockingham market. So that's going to help over the long term, you know. But with demand sitting at 37 and still trending lower, that'll get absorbed with vacancy at 2.62%. So slightly higher.
Slightly higher. And that's likewise, where does this sit on the buy, hold, sell?
Yeah, so we're going to say we'll probably hold here for another year or two maybe, and then consider selling if we can transition into other markets, because doing 103% over the last 5 years, it's well and truly performed well. But we've got to also consider our strategy. If we're a long-term buy and hold, we'll just hold it all the way through. Whereas if we're going to sort of roll through, if we're managing a portfolio of 5 or 6 properties and we don't want to go beyond that, we might sell out of Rockingham to redeploy, reduce debt, or move into other markets.
And for people that are only really joining us for the first time on the Defence Property Podcast, do go back, listen to some of our other episodes, because we do have some fantastic chats about strategy and about goal setting when it comes to property. And so one thing that Kane mentioned just then, which for our listeners I think it's worthwhile reiterating, is that this sell move is really good for those really active investors that won't necessarily just say, I'm going to hold my property for 30 years and let it do its job. It's acknowledging that, hey, in the last 5 years, I've got a 103% growth on this place. Looking forward, is it going to likely do 103% growth again? Well, maybe not, because that's really high. So it might not do the same growth again. Okay, what I'm going to do is I'm going to look for areas which are likely to have higher growth, because Rockingham might have already had its growth. So we're now going to move it out of an area that's at the apex of its growth, and then find a new growth market to put your money into. So that very active investing strategy, which of course it's up to the investor and it's up to their personal preferences.
Exactly. Yeah, I love it.
Now, back to Queensland. Somewhere I think everyone knows very well, Enoggera,
Gallipoli Barracks. So there isn't a specific LGA for, Western Brisbane, but we've clustered our Western Brisbane suburbs together to get a higher level of data than just an individual suburb of Enoggera.
Yep.
But, the Enoggera does fall in the Brisbane City LGA, so we've just clustered our western suburbs here. A 2.42% yield.
Whoa.
So it's quite low, with a median price, and that's probably picking up if you're the inner western suburbs, which is dragging our median price up to 1.575. So very high, but we're only getting $743 a week rent.
Yeah.
And this is houses, so part of the strategy, if we're going to buy, maybe let's review these numbers, but for units or townhouses in that area. So we're still in a prime capital. But then we've got to reevaluate our purchasing strategy and due diligence and say, okay, well, if we're buying a townhouse unit, we've got to cap the number of units within that complex and things like that. But our 10, 5 and 1 year growth, so over 10 years, it's done 105. So it's performed very well. And over the last 5, it's 64. So probably more in line with what we'd like to see on a slow and steady, and 9.8% over the last 1 year.
Yeah.
So a very consistent climb over the last 5, 10 years. Supply is quite low at 0.21% and trending lower. Inventory at 0.83, which is less than 1 month. And building approvals are 0.73 and fairly flat. So demand's at 34 and trending lower, and vacancy is 2.5 and also trending lower. So it's got some good supply and demand metrics for a very healthy market, and it seems to be a slow and steady chug up. And that probably comes off the back of a lot of Sydney and Melbourne
Investors
people moving up to Queensland from a lifestyle, sea change style of market. So very good long-term prospect, Southeast Queensland. So we're putting that in the buy or hold category.
Buy.
Yeah.
Even with...
So we're just going to
such a
cherry
small
pick
yield.
it. Yeah, so we're going to cherry pick and change the strategy around. And does that mean we're going a little bit further west? Or does it mean potentially looking for townhouse units where we can improve that yield but still be in that Southeast Queensland market?
Yep. Because, I mean, the Stockholm market data at 0.21% is healthy.
Yep.
It is healthy.
And it's getting lower as well.
And it's getting lower.
know.
The days on market's getting lower. The
Yeah.
vacancy's getting lower. This data is healthy for that continued growth.
Yeah.
But
I'm not sure about you, but I'm not spending 1.5 mil on an investment.
and
so
that's why when you said buy hold, Kane,
we're just shopping
surprised.
around, for our suburb in that area. Because it has got quite a few suburbs close to Brisbane City in that cluster.
So once you cut those closer in suburbs out,
We
you
might
might
go
see your
further out.
yield go
Correct.
up a little bit,
Yeah.
the price drop, but you'll still have those really healthy indicators of days on market.
Yeah.
And stuff.
So we just go sifting through all our suburbs looking for where has a healthy yield.
Yeah. Yeah, no, absolutely. Ipswich.
Yep, Rath Amberley. So we've got high confidence out there. The yield does sit at 3.06 with a median price of 847 and weekly rent of 500. So still lower than we like to see on the high level. 10, 5 and 1 year growth is 120% over 10 years, 92 over 5 and 12% over 1. So it's had great growth. Stock and market's 0.3 and trending lower. So there's less and less available. Inventory is at 0.8. Building approvals, I was at 2.73 and trending higher. So there's a lot of expansion out that way.
Put that into context, Inaugural was 0.7, Townsville was 0.6, Canberra 0.7. So this, just even from the suburbs that we've listed so far, is a fair bit higher. It's on the higher end.
Yep. Which means there's a lot of new developments out there and that additional supply. However, days on market is still sitting at 32 and it's trending lower. And vacancies are at 1.9 and a slight trend higher. So we're just going to hold here in Ipswich just because it's, again, Southeast Queensland, and we're going to cherry pick our markets to improve the yield, but our median price is still at 847. So, and if we were to cherry pick some suburbs, we might get a median price a bit lower than that, which is going to help with our yield.
847 in Ipswich is pretty wild. That is a wild figure. Moving down to Sydney City.
Yeah, it's a bit of an interesting one. Garden Island, so obviously the Navy there. And we've switched to units here, for sort of reasons that the median house price for, in Sydney City.
In Potts Point, around Garden Island will be like 10 mil.
Yeah, quite high. So for units, we're at 3.46. And a weekly rent of $1,000 and a median price for units at 1.508 mil. The 10-year growth has been 40%. 5 years been 16%, and then over the last 1 year, 3%. So I feel that if we're already in the market here, we're just going to hold it because those growth figures over 1, 5, and 10 years could indicate that we could see some growth over the next 5 or 10 years that would outperform the long-term average. However, with the yield, there's nothing wrong with selling and redeploying, to better markets because I don't think that however much we sift through all the different suburbs within Sydney City and surrounds, we're not going to improve that yield too much where it's going to, make it worthwhile holding that, having all that capital tied up. But again, it'll come back to where we are now. If we're very early in our journey of property investing and very late in the journey is going to impact whether that's a hold or a sell. Yeah. So the strategy comes into play.
I mean, I think that's very reasonable. Like looking at that, if you're talking about, anywhere from the eastern suburbs through to the Sydney CBD, through to North Sydney, through to Surrey Hills in the inner south, I guess, you're not going to be able to sift through, as you said, and find a pocket of cheap. It's just not going to happen. And I think it's very reasonable to say, but if we're talking that the average unit price here is 1.5, if you get a good off-market opportunity that saves you 15K, it's kind of change. It's really not going to shift the dial of the yield.
And to be honest, when I looked at the yield and saw 3.46, I was a little bit surprised that that was higher than I was expecting.
I was expecting the twos. Yeah. And that was
house is 100% in the twos. Low twos.
This is the discussion that you and I had a few weeks ago, which was you gave the example, and I thought it was really pertinent. I was actually talking about it with my wife because she went back. She listens to our podcasts, and she was talking about the Balmain example you gave. So do go back and listen to it for our listeners. But it was a case that the yield that you can get in, say, I think you gave an example of like Mackay and a few other places where the yields were like mid 5%. Versus the 2% yield that you get in Balmain in Sydney's inner west. And so for that average house price in Balmain, I think your example was like 2.53 mil or whatever it was. Here are 5 places that you can get in regional and outer metro areas. Here's the amount of money that they would generate in rental income, given that the yields were like 5 to 5.5, versus how much your rental income was or how much your rent would be in Balmain. And you're like, with this example, go to the outer urbans, go to the regional areas because you're going to double your income. So when I saw 3.46, that was actually higher than I thought.
Yeah.
Though, in that Potts Point area, perhaps, and this is me maybe justifying it in reverse, there doesn't seem to be a whole heap of stock coming on the market. And around that Potts Point, King's Cross area, you are within a walking distance of the CBD. You have some of the houses that can be quite nice and 1930s Art Deco buildings. So just because you're walking distance from the CBD, you still have quite high ceilings and everything. So maybe
and you're very landlocked, so the only way is to go up.
So there might be a
heritage comes into play, like you say. So,
yeah.
But Wagga Wagga.
Wagga Wagga.
Home of the Soldier, Kapuka. So a yield of 3.84, 676,000 for houses with 501 per week rent. 10-year growth has been 110%. Our 5-year growth has been 78, and 1 year has been 8.76. So we see over 10 years we've outperformed the long-term average, but over the last 1 year we're very close, slightly above the long-term average. So we can just see that we've probably reverting back to the mean, and then we're going to come slow right down.
So, 5 years, 78% growth in 5 years. Now, to be fair, a lot of the areas that we've spoken about in the past, Ipswich, 92% 5-year growth, but that's on the outer rings of Brisbane, right?
Yeah.
It's in southeast Queensland. It's a huge population corridor. Enoggera, 64%, let's be honest, in the middle of Brisbane. Then you've got areas like Canberra, 34% over 5 years. We're talking about, Wagga Wagga, which is a 6-7 hour drive outside of Sydney, to have 78% growth in 5 years. What's the secret sauce out there? What's been going on? Do you know?
I'd just say it's affordability and a change in economic activity there.
Yeah.
But and it's all cycles. So, and remember, the smaller the regional area, we'll come to Darwin shortly, but the more volatile it's going to be. So, the steeper the climb and the longer the plateau. Hence, this is a sell. Like, we want to get out while we still can. Supply is low at 0.24, but it's trending higher over the last couple of years. Inventory is at 0.9, so again, less than a month. And healthy building approval ratio is a 0.53, but our demand's at 56.
Ooh,
and
the
trending
highest we've
higher.
seen.
Yeah.
So that's days on market, 56 days on market. That's super high.
Yeah, and it's trending higher. And when we've overcooked or outperformed the long-term average, and we can see that we're reverting back to the mean, that with days on market at 56 and vacancies at 2.5, it's had its better days.
So that is giving us a sign to.
Yep. So that's a sell.
That's a sell. That is a sell. Those, look, the stock on market. Yeah, that seems fine. But 56 days on market and growing. That's not healthy.
No, that's right. And so we want to get out while we can.
Now going east, HMAS Albatross in Shoalhaven. What are we looking at there, Kane?
So 3.69% yield, 751 as a median, and 534 per week rent.
Now, so the Shoalhaven's an area, or are we looking in the town of Shoalhaven?
It's an LGA, yeah.
The
so we've got
LGA,
picked up the LGA for Shoalhaven.
Yep.
10 years done 118.
Cool, yeah, nice.
5 years 46, so it's really slowed, and then negative 0.45 over 1.
Wow.
So similar. So it is a sell, similar to Wagga. It's had similar over 10 years. But even less over 5, and then even less or negative over 1. Supplies 0.27, so quite low, but it's trending or very flat. There's no clear up or down trend over the last few years. So it's probably transitioning from a downward trend to an increase. Inventory is at 1.2, and building approval ratio is at 0.57. Demand's at 63 days, or days on market 63 days, and trending up or increasing, and vacancies at 1.69, but that's also increasing.
That's on the up.
Yeah, so very similar to Wagga.
63 days on market.
Yeah.
That is that's again. So following Wagga at 56. That's it's nearly double.
So 5 to 10 years ago, we would have seen that well under under 30, and that is slowly just increasing.
And what is this? Is it investors moving their money out of there to greener pastures? Is it population? What's the cause?
Probably a combination of all. Yeah. Yep.
Yeah, I think if you were to look at this data, you'd be, not financial advice, never is, but you might consider moving elsewhere.
Yep, definitely.
Money elsewhere.
Pick some better markets.
Victoria, finally, the Mornington Peninsula.
Here we go, HMS Cerberus. So we've got high confidence. We are at 2.46% yield, so definitely going to have to deep dive into our suburbs and maybe increase the area that we look at if we go down there to have a longer drive to Cerberus. If we median price is 1.247, and it's kind of like that. Cerberus is the Mornington Peninsula is that sea change, so we've got quite a high price point of entry.
Yeah, because it's quite a beautiful area. It's an area that a lot of people move to for their retirement, et cetera, isn't it?
So we might go on the fringes or further north from it to bring that price down,
which is where you
and get a better yield. Correct. Yeah. 10 years it's done 84%. 5 years it's done 23%. So next, 4% a year for the last 5 years, but it's done -9 over the last 1 year.
Wow. And look, everyone's going to be harbouring and focusing on that. It's 9% drop in 12 months, which is a stark figure. One figure I'm actually really surprised about is 84% over 10 years, because it's not massive.
No, that's right. It's only just, so probably again in that of the 10 years, 1, 2, and 3 is where a lot of that 84% come from, because we can see over the last 1, definitely, and last 5, it's been very flat and nothing. But what's interesting, supply is still very low. Stock on market at 0.24% and trending lower. Inventory's less than 1 month at 0.98. and building approval ratio is a slight decline of 0.59. So although there's lots of growth left in the tank, it's still a very low stock environment, which is great. And then demand's at 43 days, so a little bit higher than we'd like to see it. And vacancy at 1.78%, both slightly increasing. But that just means I think that we can get a really good entry to this market with strong negotiation. So we're going to be very selective with our suburbs. There's no rush or FOMO here to hurry up and get in. So patience is key. If we were to buy there today, we could be waiting a year or two maybe for that growth. But we're getting in at a sort of an early adopter or beating the masses. Now, it's got growth and legs in it to go.
Yeah, the numbers on that beachfront house are going to be very different because we're looking at averages here, right?
Correct.
The numbers that you would have on the beachfront house are going to be very starkly different to even 1 street back, 2 streets back, 3 streets back.
Yep.
And then when we're talking about an entire LGA being a suburb away, 5-minute drive, you will see very starkly different yield, very starkly different house prices. So buy, hold, or sell?
Buy. But what's consistent with what you were saying there, Liam, is most likely the 5, 10 and 1 year growth rates are very similar across all those regions and suburbs, but it's the yield and the price that you're highlighting with being a street away, a suburb away, which is why the region is a buy, because we've got good growth over the next 5 years, and it's an early adopter market. So we're just going to pick our right suburb.
So talk to us, because you and I went out for lunch, a couple of months. Actually, it was before Christmas, 5 months ago. And you and I were talking about buying in the Victorian market, buying in Melbourne. I was still a bit, don't know. You seem to be a little bit more bullish with it. You had a bit more trust in that market. What would you say to our listeners that are maybe still a little bit risk averse to go south of the border and dabble in Victoria?
I'll just say I think it's the right time, for performance over the next 5 to 10 years. It should perform very well.
Some of the yields in Melbourne are so...
Yeah, so you do have to shop around a little bit. And that, if the yield and depending on your overall cash flow position, you may choose or want to investigate, the Ballarats, the Bendigos, the Alburys maybe. But Victoria as a whole is... And we're not too put off by land tax either. If we look at...
Because it's quite marginal. It's more than people...
but it's just a very scary term, land tax. But if you put it with your rates and your land tax, and then you compare it to... Because rates are quite reasonable in Victoria. Say a regional Queensland where our rates are quite high, but then we've got high insurance premiums. It's much of a muchness. But if one's going to vastly outperform the other growth-wise, it's definitely worth buying, because we'd expect that yield to increase when we look at yield on purchase price, not yield on value through our whole period.
Yeah, and that makes a lot of sense. I think, and I agree with all of the economic financial factors that you're talking about. That's something that I've been dwelling on. And the only reason that I personally haven't dabbled is because the yield is so, in some of these areas, so frighteningly low. I mean, you go to the outskirts of Geelong and you're finding places that are almost like in the low 400s. You're, oh my gosh, like that's insane. And you're, it's because it's like $250 a week. Like I'm actually going to be like amazingly out of pocket for this. So, but that's your point. So that's why you shop around.
But it's a great market if you are looking for a really old dwelling where it's potential knockdown and rebuild. And if your appetite is along the lines of putting a couple of units or townhouses or something like that, it's a very good market to be. If you want to buy now and you can carry the low yield for a few years, and you've got that development appetite, it's a good market now to be looking for those future projects.
Absolutely. Now we're down to southwest Sydney with Holsworthy in
Barracks.
Liverpool was that Liverpool defence area?
Yeah. So I spent 3 years there myself. The 17 construction unit.
Nice. Were you living on base or off base?
No, so we had a married quarter in Wattle Grove, if you know it.
Wattle Grove. Yeah.
Used to go to the Wattle Grove Hotel.
Yeah.
Used to do 2-for-1 meals out there. I think it was a Wednesday night, a few pints and a 2-for-1, and then Sporties on the weekend.
Sporties, that's it.
A short drive to Cronulla. So our yield's at 2.77 with a median price of 1.194 and $638 a week rent. So again, not great. Our 10 years 80%, 5 years 56%, and 1 year's 8%. Supply is at 0.19% with a very mild downward trend. Inventory at 0.69 and building approval ratio at 2.23. So 2.23 is probably a little bit higher than a lot of, definitely Sydney City and a few other more built out areas. Demands or days on market is sitting at 44 and increasing, and vacancies at 2.05.
44 days on market for something which is, not that far out of Sydney CBD. Like in the scale of things, 44 is quite high.
Yes, and it's trending higher.
Yeah.
Yeah. So I've put it as a sell just because I think we can, from the yield, again, I don't think we're going to do a lot better than, 2.77, especially with if we're, spending 1.1 or 1.2 almost, for $600 a week rent. I just think we can do much better from growth and yield.
Yeah.
So we're not ticking any boxes,
No, I totally agree. And look, it might. Again, you've had 8% growth in the last year. It's actually quite decent for Sydney.
Yeah.
I think that is looking at some of the top quartile, because I know you and I have spoken about this in the past, but a lot of that growth is concentrated in more affordable houses because that's where the money's flooding. If you're a $10 million home, you've got less money flooding there because so few people can afford it that the growth just isn't necessarily there. But so 8% I think is actually a very reasonable year-on-year growth.
Yep.
But you see just how much stock, not necessarily in the Liverpool government area, but in surrounding suburbs, and how much new builds you've had. It would just be one LGA outside of that in Campbelltown, around Camden, around Macquarie Fields, and even with the new Badgerys Creek Airport and around there, you've got like Leppington, Oran Park, So while this, the number of building in Liverpool doesn't necessarily, it seems normal.
Yeah.
You're only about 15 minutes from entire new suburbs that have been created.
That's right. Yeah. And I guess there's there's two ways to interpret our buy, sell, or hold rating. That there's, if we don't own there and we're just moving around on a posting order, or not moving around on a posting order at all, we're just looking for an investment, we've got a clean slate essentially, and then we can just take the rating we've given it on more face value. But then there's, if we own there, and how do we then interpret it to what do we do with that we already own there? Because that can, as we know, transactional costs are quite high to get in and out of markets. So we might interpret the rating we give each one a little bit differently, depending on if we own there and what our long-term goals and strategy are for our portfolio.
Absolutely. And just you comparing it to some of the other areas that you've mentioned already, with that 1.2-ish million average house price, and you're getting 640 a week, where can you better put your money to work for you? We've listed half a dozen to a dozen suburbs around Australia, which they're averaging 600-700K, but they're only your rent's only $100 a week less. So if you've got a $1.2 million place out there, your money could be working for you far better elsewhere with two. Oh, you're about to say
on
something.
that, let's jump into the next one. And by no means am I saying that Darwin, Robertson Barracks.
Oh, I said there we go. I've got the
there you go.
best
So the
example
perfect
right
example
after.
of what you're saying.
Okay, but we're
now
a
you
sell
go
for
into this and have a
Holsworthy.
look.
We're a sell in Holsworthy.
Yeah, so we're a sell
We're a
Holsworthy,
sell.
just based on yield, and we're probably not seeing huge growth. We're not seeing huge yield. There's not a lot going on there. It is a sell.
But not necessarily the next one, Darwin.
Right. So what you're saying there is, can we redeploy and get better yield somewhere? So I'll jump to the end and say Darwin's a hold, is not a buy, just because the size and remoteness of Darwin, being that it's a more volatile market, that it's going to have steeper climbs and longer. But if we're already in there and got it, we're going to hold it.
Yeah.
But what you were saying, so Liverpool had a median rent of $638. Darwin has a median rent of $631. So it's median
difference.
$7 difference. But the median price of Liverpool was 1.194, so 1.2, let's call it. Whereas the median price of Darwin is 669.
So same
almost
rental income.
Yeah.
And this you can get basically two for the price of one.
Yeah, exactly. So our yield's sitting at 4.9. And again, this is houses and the LGA, so we can definitely do better than that 4.9 by picking our markets.
Now, I think I'm looking ahead in your data. I'm reading the next line because for our listeners, Kane very kindly pulled this data together, and I was looking at it before. The 10-year growth. What the hell happened there?
So that's that volatility we're talking about. So, prior to the 10 years, so if we go back, say, 15 or 2007 to 14, huge growth.
Huge.
And then it's just done nothing and actually negative since.
So our 10-year growth in Darwin is minus 2.4.
Yeah.
Our 5-year growth
that's
is
minus
16.
for that 10-year period.
Yeah.
So essentially 0 for 10 years or flat.
Wild.
But then over 5 years, it's done 16%. So, and that's probably, and then the last 1 year, -5. So it's just sort of fluctuated
Why
the
is
last
that?
couple. Just a combination of economic activity, affordability, but now yields are increasing, and it's reverted away from the median growth rate for so long that we'll expect it to increase and climb back to that long-term average. But it is a matter of we have to ride it out if we've already got property in that market.
Yep.
Depending on how long you've been there, you could be getting out and just to cut your losses and move away, just because of that volatility.
Yeah, I mean, we're saying volatility, but it just looks like it's going down.
Well,
yeah.
yeah. But it can only, it's like Melbourne. So Melbourne's always been second to Sydney and very close second. But now there's Brisbane, Canberra, and Adelaide on a median price is higher than Melbourne. So that can't keep going forever.
Yes.
Do you know what I mean? And we're seeing that now where people and investors are moving back to Melbourne. Darwin will be no different, but it's just going to have those steeper climbs and longer plateaus of nothing, which is what this is telling us.
Yeah, that's right. And so some of the data, it's kind of, look, you got to talk me through it because the supply, the demand, the inventory, it seems like it's telling a bit of a mixed bag
so
story.
supply is very low at 0.12 and a mild trend lower. Inventory is at 0.43, so call it a fortnight, and everything's gone. And building approval ratio is at 0.43 and sort of
looking
flat.
at that alone,
very low supply.
Yeah, so looking at that alone, you'd expect
nothing.
it'd be okay.
That's right, and nothing over the last 10 years.
Yeah.
It's got growth in it. It went through a very steep climb and then nothing for 10 years.
But then the demand.
But the demand's just not there yet.
So demand.
But as we see the East Coast and everywhere keep growing, it can't stay cheap forever.
Yeah. The days on market, 77 days on market, which is our biggest days on market by no short of a margin. And vacancy is actually quite good at 1.42, but
slightly increasing.
Slightly increasing. So what we're seeing is supply is not coming on board. But just because there's no supply, it doesn't mean
there's just no demand there.
There's no demand at all. Is that a case of, I suppose, what I would be looking at this and not having read the data, but it seems perhaps there's not much population growth there.
Yeah, potentially.
Because they've kind of
and not enough
equaled
economic stimulus to bring in population and jobs and stuff. So definitely one for further investigation if we were to buy there. But I just personally feel there's always going to be better opportunities.
Now we're down to Wodonga.
Bandiana, Latra Barracks.
Is that the one that falls in Victoria? It's Albury that falls in New South Wales, Wodonga that falls in Victoria.
Correct, yeah.
That's the one.
So commonly known as Albury Wodonga.
Yes,
but, I've just got it down as Wodonga is the official region of the military barracks there that they are in Victoria. So we've left Albury off, but we could probably, if we were going to buy in Wodonga, we could probably investigate Albury as well.
Yep.
When we start diving into some suburbs. Quite a healthy yield of 4.32%. A median price of $593 and median rent of $494. The 10, 5 and 1 year has been 98 over 10 years, 56 over 5 years, and 0.93, so 1% over 1 year. So and I did check the 3 year on this one. The last 3 years, it's done 2%. So essentially 2%. It's done nothing over the last 3 years.
Yeah.
But supplies are very low at 0.22% and trending lower, which is good. Inventory at 0.8 of a month. So less than 1 month and it's all gone. And building approval ratios are 1.7 and trending or very flat. Demand's at 56, and we can sort of see on the trend line that it's flattening out, and vacancies at 1.46. So we've got a strong yield here, a very good median price to get into, and nothing over the last 3 to 5 years. So we've actually said we're going to buy in Wodonga.
It's a strong call.
Yeah.
Where do you expect it'll go?
It's very hard to predict future growth.
Yeah,
we don't do that.
Not financial advice, Bubba.
But I just think it's very low supply. We've done nothing. We've flattened over the last 3 years, and strong yield and a good median price to get into. I think we'll do well there.
Yep, that makes total sense. And for number 13, we're up to Newcastle.
So 3.15 on the yield. Call it 1.1 median and $663 per week rent. So this is very similar to a Liverpool, that the yield is quite low, 600 or that 600 range
really
rent.
similar stats.
Yeah,
really similar.
for a mil. Done 110% over 10 years, 60% over 5 and 8% over 1. Supply is low, inventory is low, building approval ratios low and healthy. Demand's 31 but increasing, and vacancies 1.7 and increasing as well. So not quite as bad. So the yield, I'm definitely not buying there. But if we're already there, we're probably going to hold.
Yeah, some of those statistics are still quite strong. There's not necessarily a supply. The demand is healthy. So
if we're buying, we're probably going to find somewhere better.
Yep.
But if we're already there, we might hold it for a little bit more, a little bit longer.
3.1% yield, you can definitely find better.
And depending on how long we've owned there, and this goes for all the regions that we've given a hold to, the 3.15% yield is on the value of entry today. If we brought there 3, 5, 10 years ago, our yield is probably a lot stronger on our purchase price, not current value. So if we've been in this market for quite a few years, or any of these hold markets, we're probably not feeling the same shortfall or cash flow pinch that we are if we bought there today.
Yeah.
And that sort of comes back to that piece of, if we don't have any exposure to these markets, we're sort of interpreting the buy, the hold, and the sell different to if we're actually exposed to these markets with a property there. But that gives us, 4 buys, 5 holds, and 4 sells across
even split.
Fairly even, but again,
Even
like I was
split.
saying, we're going to interpret those a little bit differently when it comes to
Your exposure to the markets.
and where we're going, moving around, and things like that.
Of course, and it ties into your eligibility for support.
Yep.
Because perhaps not, I don't want to put words in your mouth, but perhaps there might be a case where if you do have a DOHAS entitlement and you're moving to maybe if there was a healthier hold, you might say, well, if you get your $900 a month, then you might advise they jump into a hold market.
Yeah, that's right. And I guess we're going to look at do we qualify for DOHAS? Do we have DOHAS tier 2 or 3, which is going to impact the overall plan. Rent assistance is sort of, again, these are just very high level sort of indicators of what we might do with each market, but our overall strategy is going to really influence it to make sure. I think we worked it out to be close to $20,000 per year of cash flow on tier 2 DOHAS and receiving rent assistance. So that's definitely going to impact some of the decision, and that's why not looking at Townsville was a buy or a hold or a sell in isolation, but considering that title we've given it with our current property portfolio or nothing, if that's where we are, along with our posting cycle and our entitlements that we can utilise, and putting it all together into one plan.
Yep, you sum them all up and then you create the holistic goal and how you get there. Kane, we've gone for an hour. Almost an hour.
There we go. I wasn't expecting that. But
if
13 regions, I guess.
13 regions. Now, if you've been listening and you want to get involved, you want to learn more about how you can perhaps use your entitlements wisely. And I know this is something that Kane and I have spoken about on a lot of podcasts. I'm not going to name names. We're never naming names here. We're good people. But, we do hear stories that people get told, don't use it. Don't use our house. Don't do this. Don't do that. Just if you ever want advice, speak to Kane and Kane's team from Discover Buyers. Discover Buyers Agents, they'll be happy to help you out. How can they get in touch?
Yep, just discoverbuyersagency.com.au or reach out to me. You'll find all our details on the website. It's funny you say that as well, actually. Sorry, I spoke to a financial planner earlier this week, and we're just having a chat, sort of sussing each other out, I guess, in that initial sort of when you meet someone.
Yeah.
And he goes, I did listen to one of your podcast episodes and I heard you mention about, when a broker says, don't worry about DOHAS, it's not worth it. And then your advice was pretty much get a new broker. He's like, pass the sniff test for me, because he's sort of like saying the same thing.
True.
100% agree. And there's a lot of people that just say they put in the too hard basket, or I'm not going to get paid doing it. So,
because it's like, because NAB is direct to bank.
Yep.
Right? Direct to bank. So if you go to a broker, they're not going to, they can't refer you to NAB. Yeah. So now they've got very few options, and a lot of brokers aren't going to know about it. So they're going to have to teach themselves to get very few options, and it might not be worth their time. They're just going to try and fast track you. But this is why you have people, experts in your corner like Kane, that can walk you through it. So do reach out to Kane and the team, and they'll be more than happy to help. Kane, I think that's all we have time for today. But we're going to be back in a few weeks with just another episode.
Excellent.
Yeah, as always, mate. It was a pleasure to see you. Hopefully you're all safe with the cyclone.
Yeah. Hopefully it's dried out in Queensland by the time I get back.
Yeah, I hope you can make it through. But that is all we have time for today to all of our listeners, and we'll be back at the same time next week with, not next week, next month.
Next month.
I was expediting it with another episode of the Defence Property Podcast. Until then, share the episodes. If you've got a family friend or a family member or anyone who is looking to buy a property and they're looking to navigate their journey here, send them the podcast, send them Kane's details, and Kane will be more than happy to help out. But until next month, we'll be back then. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.